Consider a Roman citizen centuries ago paying a portion of the grain harvest to the state, then living for long stretches afterward with no direct tax on income at all. Since the empire relied instead on customs duties, inheritance levies, and taxes collected from its provinces, this single fact, an entire imperial civilization sustaining itself for generations without anything resembling the paycheck deduction most of us now take entirely for granted, is worth sitting with for a moment before we go any further tonight. Now consider you lying here tonight, whose earnings were quietly reduced before the money ever reached your bank account, whose purchases are taxed again at the register, whose property may be taxed simply for existing year after year, regardless of whether you buy or sell anything at all. The difference between these two, an entire civilization functioning for centuries without anything resembling a modern income tax, and a modern life touched by taxation at nearly every single transaction, is startling. And the reason this contrast exists is at the heart of everything we are going to explore tonight. It is not that ancient societies were somehow more lightly governed or less demanding of their citizens than modern ones. Rome extracted enormous resources from its population and its conquered territories, funding one of the largest and most sophisticated states the ancient world had ever seen. The contrast lies instead in exactly which forms that extraction took and how visible or invisible those forms were to the people experiencing them. A grain tax, paid once at harvest, felt and looked entirely different to the person paying it than a modern paycheck deduction, invisible, automatic, subtracted before the money is ever seen at all, even though both, in their own era, represented society's mandatory claim on a portion of what an individual had produced. This question of visibility is worth sitting with for a moment longer because it will resurface in a considerably more deliberate and consequential form. Later in tonight's history, a tax that arrives as a single large visible payment tends to provoke a very different emotional and political response than the exact same total amount of tax collected quietly, in small increments, spread across many smaller transactions or paycheck deductions throughout a year. This is not simply a matter of psychology in the abstract. Governments and tax administrators have, across the entire history we are about to trace, repeatedly discovered that the specific mechanics of how a tax is collected, all at once or gradually, visibly or quietly, can shape public tolerance for that tax nearly as powerfully as its actual size. If you have ever wondered why taxes seem so chaotic, so unevenly applied, so difficult to fully understand even after filling out the same forms year after year, the answer starts right here, in this contrast. And by the end of tonight, it will make more sense than it ever has. And if you are here because taxes have been on your mind, a confusing form, a paycheck that never quite matches what you expected, a nagging sense that you are paying more than your fair share, or perhaps less than you should, you are in the right place. Not because we are going to give you a list of things to do about it, but because once you actually understand what taxation is, why it exists, and how it evolved into its current sprawling form, most of the confusion just settles on its own. And sometimes that understanding is the thing that needed to happen first. But let us start somewhere closer, right here, in the world you live in, at this moment, somewhere in the paperwork you have filled out, the paycheck you have received, the receipt sitting in your pocket. There is a thread connecting you to every single one of the people and moments we are about to walk through together tonight. Let us begin with the simplest possible way to describe a tax, and then slowly add the layers that make it genuinely interesting. A tax is a mandatory financial contribution, collected by a government used to fund collective goods and services that would be difficult or impossible for individuals to provide efficiently on their own. Roads, courts, national defense, public education, emergency services. These are, broadly, things that benefit an entire society that are difficult to charge for individually in the way a private business charges for a private product, and that history has repeatedly shown to be poorly provided when left entirely to individual, voluntary contribution. Consider a concrete, everyday version of this same principle before we reach the more formal lighthouse illustration. Imagine an entire neighborhood of households, each of whom would genuinely benefit from a smoothly paved road connecting their homes to the wider town, saving everyone considerable time, wear on their vehicles, and general frustration. If paving this road required each household to voluntarily contribute its fair share, with no enforcement mechanism at all, a rational household might reasonably calculate that enough of its neighbors will contribute regardless, allowing the household itself to enjoy a smoothly paved road without paying anything toward it. If a meaningful number of households reason this way simultaneously, the road either never gets built or gets built in a much poorer, underfunded form than everyone genuinely wanted, despite every single household along that street preferring the fully funded, well-paved alternative. This is worth sitting with because it is not a story about anyone being selfish or dishonest in any unusual way. It is simply what happens when a genuinely beneficial collective good depends entirely on voluntary contribution without any mechanism ensuring that contribution is actually made. This single idea that some goods and services are better funded collectively through a mandatory system than left to voluntary individual choice sits underneath every tax that has ever existed. In every civilization we will discuss tonight, economists have a specific name for the underlying problem. Taxation is designed to solve the free rider problem. A road, once built, benefits everyone who drives on it, whether or not they personally contributed to its cost. If contribution were entirely voluntary, many people would reasonably choose not to pay, correctly calculating that the road will likely get built anyway using other people's contributions and that they can simply enjoy the benefit without incurring the cost. If enough people reason this way, the road never gets built at all, even though everyone, including the very people who declined to contribute, would have genuinely preferred a world with the road in it. Taxation solves this problem by making the contribution mandatory, ensuring the collective good actually gets funded, rather than left to the unreliable self-defeating logic of voluntary individual choice. A classic illustration economists often use to make this concrete involves a lighthouse, standing on a rocky coastline, warning passing ships away from danger. Every ship that passes benefits from the lighthouse's warning light, whether or not the ship's owner ever contributed a single coin toward building or maintaining it. And there is no practical way for the lighthouse keeper to switch the light off selectively for ships that decline to pay while leaving it on only for those who did, left to purely voluntary funding. A rational ship owner might reasonably calculate that other owners will fund the lighthouse regardless and decline to contribute themselves, and if enough owners reason the same way, the lighthouse never gets built or maintained at all, despite every single ship owner along that coastline benefiting enormously from its existence. This example is worth taking a little further, because economic historians studying actual lighthouse funding across different eras have found a genuinely interesting real-world nuance to it. In several historical cases, lighthouses were, in fact, initially funded through private, voluntary arrangements, often organized by groups of merchants with a direct commercial stake in a particular shipping route, rather than through government taxation from the very outset. These private arrangements tended to work reasonably well only under fairly narrow conditions. A small, identifiable group of beneficiaries who could coordinate directly with one another, often the same merchants using a specific port repeatedly, rather than the enormous, anonymous, ever-changing population of ships that might pass a given point along a busy international shipping route. As shipping traffic grew larger and more anonymous, involving vessels and owners with no ongoing relationship to any local group of merchants, these private, voluntary arrangements generally proved insufficient, and most major lighthouses eventually transitioned to public, tax-funded operation precisely because the free rider problem became unmanageable once the pool of beneficiaries grew too large and too anonymous for informal, voluntary coordination to reliably solve on its own. This is precisely the kind of good benefiting everyone regardless of individual contribution, nearly impossible to restrict only to paying contributors. That taxation exists specifically to fund reliably, and lighthouses have, in fact, historically been funded through exactly this kind of mandatory levy in many maritime nations. A direct, tangible illustration of the abstract economic principle at work. There are, broadly, several different categories of tax worth distinguishing clearly, since understanding these categories will make a great deal of confusing news coverage and personal paperwork suddenly make sense. There is income tax, levied on the money you earn from working or from investments. There is consumption tax, sometimes called sales tax or value-added tax, levied on the money you spend purchasing goods and services. There is property tax, levied on the value of real estate or other significant assets you own, typically collected annually, regardless of whether the property is bought or sold that year. There is payroll tax, a specific category of tax levied directly on wages, often earmarked to fund particular programs like retirement pensions or health insurance. There is corporate tax levied on the profits earned by businesses. And there are various smaller, more specific categories, including capital gains tax, levied on the profit made from selling an investment, and excise or tariff taxes, levied on specific goods, often imported ones, sometimes to raise revenue and sometimes to discourage consumption of a particular product entirely. It is worth distinguishing a little more carefully between two forms of consumption tax that are often confused with one another, since different countries around the world rely on different versions. A simple sales tax is collected only once, at the final point of sale to the end consumer, with no tax collected at earlier stages of production. A value-added tax, used widely across many countries, is instead collected incrementally at every single stage of production, with each business in the supply chain paying tax on the value it specifically added at its own stage, and typically claiming a credit for tax already paid by the businesses before it in the chain, so that the same underlying value is never taxed twice as it moves through the production process. Consider how this plays out concretely across a simple supply chain. A farmer sells wheat to a mill and charges tax on that sale, remitting it to the government. The mill, when it later sells flour to a bakery, charges tax on that second sale, but claims a credit for the tax it already paid to the farmer, meaning it only actually remits to the government the tax on the additional value the milling process itself added. The bakery follows the same pattern selling bread to you, claiming credit for the tax already paid to the mill and remitting only the tax on the value the baking process added. By the time the bread reaches your hands, the correct total amount of tax has been collected across the entire chain, but no single business paid tax twice on the same underlying value, and each business along the way had a direct financial incentive to properly document and claim credit for the tax paid by the business before it, creating a natural paper trail that makes it considerably harder for any single participant to simply disappear with uncollected tax revenue. Compare this to a simple sales tax collected only once at the final bakery counter. If the bakery simply failed to report that final sale, the entire tax on the whole chain, from wheat to flour to bread, would be lost in a single stroke, with no earlier stage of the process having collected any portion of it at all. The value-added structure spreads both the collection and the incentive to document it across every single link in the chain, making the system considerably more resilient to any one dishonest participant than a system relying entirely on honest reporting at just the very last step. The two approaches, despite this structural difference, are generally designed to arrive at a similar final tax burden on the end consumer. But the value-added approach has a genuine administrative advantage worth understanding because tax is collected incrementally at every stage, with each business in the chain having a direct financial incentive to properly document the tax paid by the business before it in order to claim its own credit. The system creates a kind of built-in paper trail that makes large-scale evasion at the very final point of sale considerably more difficult than under a simple sales tax collected only once. At the very end of the chain, where a single dishonest final seller could otherwise evade the entire tax alone, there is a related concept worth understanding, one that helps explain why economists often care not just about how much revenue a tax raises, but about how a tax is specifically structured, the idea of deadweight loss. Before we reach that concept, it is worth understanding one further wrinkle specific to corporate taxation that surprises many people the first time they encounter it: the possibility of the same underlying profit being taxed more than once as it moves from a business to its ultimate owners. When a corporation earns a profit, that profit is typically taxed once at the corporate level. If the corporation then distributes some of that after-tax profit to its shareholders in the form of a dividend, many tax systems tax that dividend income again at the individual shareholder's own tax rate, meaning the same original profit can effectively be taxed twice before it ever reaches an individual's pocket in spendable form, once at the corporate level and again at the personal level. This phenomenon, sometimes called double taxation of corporate profits, has generated considerable debate among economists and policymakers about whether it represents a genuine unfairness worth correcting, since the underlying economic activity generating the profit only happened once, or whether it reflects two genuinely separate, legitimate taxable events: the corporation's own profit and the shareholder's own separate personal income, each appropriately taxed in its own right. It is worth noting that this debate connects directly back to the tax incidence question we discussed a moment ago, since the true economic burden of the corporate-level tax portion of this double taxation does not necessarily fall neatly on shareholders alone. Depending on market conditions, some of that corporate tax burden may, in practice, be passed through to consumers via higher prices, or to workers via lower wages, exactly as our earlier illustration of tax incidence would predict, meaning the popular framing of double taxation as a burden falling squarely and exclusively on wealthy shareholders somewhat oversimplifies a considerably more complicated underlying reality, one where the true incidence of the corporate-level tax may be distributed across a much broader group of people than the shareholders technically receiving the dividend. Different countries have adopted quite different approaches to this question, some offering reduced tax rates specifically on dividend income to partially offset the earlier corporate-level tax, others integrating the two levels more fully, and others leaving the two taxes essentially separate and uncoordinated, reflecting the same kind of genuine, unresolved disagreement about fairness that runs through so much of the tax history and debate we have traced tonight. Whenever a tax is applied to a transaction, it can discourage some transactions that would otherwise have taken place simply because the added cost of the tax makes the transaction no longer worthwhile for one or both parties involved, even though both parties would genuinely have benefited from the transaction absent the tax. This lost economic activity, the transactions that simply never happened because of the tax, represents a cost to society considerably harder to see than the revenue collected, since no receipt or record exists for a transaction that never occurred in the first place. The window tax we discussed earlier offers one of history's clearest illustrations of exactly this dynamic in action. The government collected some revenue from households that kept their windows and paid the tax, but it also lost out on revenue entirely from every window that was bricked up specifically to avoid the charge, while simultaneously imposing a genuine cost in reduced light and ventilation on the households making that choice, a cost that shows up nowhere in the government's collected revenue figures at all. Some historians and public health researchers have gone further still, suggesting that the window tax's effect on ordinary living conditions may have carried genuine, measurable health consequences, since reduced natural light and poorer ventilation in the homes of households too poor to simply pay the tax without adjustment were associated in various contemporary accounts with the kind of damp, poorly ventilated living conditions that contributed to the spread of certain respiratory illnesses common in the period, whatever the precise scale of this specific health effect, which remains debated among historians given the difficulty of isolating it from the many other factors affecting public health during this era. The broader principle stands as a genuinely striking illustration of deadweight loss extending beyond pure economics into the physical lived conditions of the people responding to a tax. A policy designed simply to raise revenue efficiently, using window count as a convenient proxy for wealth, ended up measurably reshaping the physical architecture and possibly the health of an entire nation's housing stock for well over a century. Economists generally consider a tax more efficient in this specific technical sense when it distorts fewer decisions and discourages fewer otherwise beneficial transactions, which is part of why taxes on goods and activities that people are unlikely to change their behavior around land itself being a frequently cited example, since the supply of land cannot be reduced in response to being taxed, are often considered from a narrow efficiency standpoint. Less economically distorting than taxes on activities people can and do meaningfully adjust in response to the tax, like labor or investment, or, as the window tax demonstrated rather dramatically, the number of windows built into a house. There is a distinction worth understanding clearly among these categories, one that shapes an enormous amount of political and economic debate about taxation. The difference between progressive, regressive, and proportional taxes. A progressive tax takes a larger percentage of income from higher earners than from lower earners, meaning the tax rate itself rises as income rises. A regressive tax does the opposite, taking a larger percentage of income from lower earners than from higher earners, even if the tax rate itself is technically identical for everyone, simply because lower earners tend to spend a larger share of their total income on the taxed goods or activities. A proportional tax, sometimes called a flat tax, takes the exact same percentage from everyone, regardless of income level. Consider a concrete illustration of why an identical tax rate can still function regressively in practice. Imagine a consumption tax applied at the same percentage rate to groceries, charged identically to every household regardless of income. A household with a modest income might spend nearly all of its earnings on necessities, including groceries, meaning this tax effectively touches almost their entire income. A considerably wealthier household might spend only a small fraction of its much larger income on groceries, with the remainder going towards savings, investments, or luxury purchases untouched by this particular tax entirely. Even though both households pay the exact same tax rate on every dollar spent on groceries, the modest income household ends up paying a considerably larger share of its total income toward this tax than the wealthier household does, precisely because groceries represent such different proportions of each household's overall budget. To make this concrete with illustrative figures, imagine a household earning a modest annual income that spends a considerable share of that income on groceries each year, compared to a household earning several times more that spends only a small fraction of its much larger income on the exact same category of groceries. If both households pay an identical percentage tax rate on every grocery purchase, the modest income household ends up handing over a meaningfully larger share of its total annual income to this single tax than the wealthier household does, simply because groceries occupy such a different position in each household's overall budget, even though neither household is treated any differently under the letter of the tax law itself. This is the essential mechanism behind regressivity, and it is why many consumption taxes around the world include specific exemptions or reduced rates for necessities like basic food, precisely to soften this regressive effect on lower-income households. Most income tax systems around the world are structured progressively, with tax rates rising in brackets as income increases. Most consumption taxes are, by their basic structure, at least somewhat regressive, since lower-income households typically spend a larger share of their overall income on taxed everyday purchases than higher-income households do, even though everyone pays the identical tax rate at the register. This last point deserves a moment of careful attention because it resolves one of the most common sources of confusion about how progressive income tax actually works. Many people believe that moving into a higher tax bracket means their entire income suddenly gets taxed at the higher rate, a genuinely understandable but mistaken impression that causes real, unnecessary anxiety around promotions and raises. In reality, a progressive tax system with brackets applies each rate only to the specific slice of income that falls within that particular bracket, not to the entire income at once. Picture a simplified system with just two brackets. The first portion of income, up to a certain threshold, taxed at 10%, and everything earned above that threshold taxed at 20%. If you earn exactly at that threshold and then receive a raise that pushes you slightly above it, only the additional amount above the threshold is taxed at the higher 20% rate. The income you are already earning below the threshold continues to be taxed at 10%, exactly as it always was. It is worth walking through a slightly more concrete version of this same example, since seeing the actual arithmetic tends to dissolve the anxiety more effectively than the general principle alone. Suppose the threshold sits at a certain round number, and your income rises from just below it to a modest amount above it. Only that modest amount above the threshold is taxed at the higher rate. Every dollar you were earning before still falls into the lower bracket and is taxed exactly as it always was. Your total tax bill rises, but only by the tax owed on that small additional slice, never by anywhere close to the full higher rate applied retroactively to your entire income. Your overall blended effective tax rate, the actual total percentage of your entire income paid in tax once both brackets are combined together, rises only slightly, nudged upward by the small sliver of additional income now taxed at the higher rate, never anywhere close to the full 20% applied to your entire earnings. This distinction between your marginal tax rate, the rate applied to your next additional unit of income, and your effective tax rate, the actual overall percentage of your total income paid in tax, once every bracket is properly accounted for, is one of the single most useful pieces of financial literacy available to anyone who has ever worried that a raise might somehow leave them worse off overall. It essentially never does, under any progressive bracket system functioning the way brackets are actually designed to work. But to understand why taxation takes the specific, often confusing shape it does today, and why the contrast we open tonight's conversation with, ancient societies functioning without income tax, modern life touched by taxation everywhere, exists at all, we need to go back. Not because history is interesting for its own sake, though it very often is, but because the present, on its own, does not fully make sense without it. So if taxation is simply society's way of funding what it cannot efficiently fund through purely voluntary individual choice, how did this idea first take shape? And how did it evolve into the sprawling, multi-layered system most of us now navigate every single year? Some of the earliest recorded taxation systems in human history emerged even before ancient Egypt's grain levies. In ancient Mesopotamia, where clay tablets recovered by archaeologists document mandatory contributions of grain, livestock, and labor owed to temple authorities and local rulers, alongside detailed records tracking exactly who owed what and when it had been paid. These Mesopotamian tax records are, in fact, among the very oldest written documents human civilization has ever produced, predating even the earliest surviving literature, which tells us something worth pausing on. The impulse to record, track, and enforce a mandatory contribution toward a collective authority appears to have been one of the very first uses human beings found for writing itself, arising even before writing was used to record stories, laws, or personal correspondence. Some of these Mesopotamian records describe what may be the earliest known instance of a tax protest, with certain administrative texts describing officials investigating complaints that tax collectors had demanded more than was properly owed, a grievance that, as we will see throughout tonight's history, has proven remarkably durable across every subsequent era of organized taxation. Some of the earliest recorded taxation systems in human history emerged in ancient Egypt, roughly 5,000 years ago, where taxes were often collected not in currency, which did not yet exist in its modern form, but in kind. A portion of the grain harvest, or a mandatory period of labor owed to the state, called corvée labor, used to build the very monuments and infrastructure, canals, temples, and famously the pyramids themselves, that still define our image of ancient Egyptian civilization today. Scribes maintained detailed records tracking exactly how much grain each household owed and had paid, and tax collectors, sometimes accompanied by officials measuring the annual flooding of the Nile to assess how bountiful the coming harvest was likely to be, traveled through the countryside collecting what was owed. This practice of measuring the Nile's flood specifically to calculate tax obligations deserves a moment of further attention because it represents one of the earliest known examples of a government adjusting a tax obligation based on genuinely observed, verifiable economic conditions, rather than demanding a flat, unchanging amount regardless of circumstance. Officials used devices called nilometers, structures built along the riverbanks with marked measurements to track precisely how high the annual flood rose, since a higher flood typically meant richer soil deposits and a more bountiful harvest to come, while a lower flood signaled scarcity ahead. Tax obligations were adjusted accordingly, a genuinely sophisticated early recognition that a fixed, inflexible tax demand, applied regardless of an actual harvest size, could push a struggling household into genuine crisis during a poor year. An early ancestor of the more flexible, income-sensitive tax structures that would not become widespread again in most of the world for thousands of years afterward. This early system already contains a detail worth carrying forward through the rest of tonight's history. Taxation, from its very earliest recorded instance, was tied directly to the tangible, physical resources a society actually had available, grain and labor, rather than to an abstract concept of income measured in currency, which simply did not yet exist as a widespread medium for most transactions. The Roman Empire developed a considerably more elaborate system, relying heavily on a practice called tax farming, in which the state auctioned off the right to collect taxes in a particular province to private individuals called publicans, who paid the state a fixed sum upfront and then kept whatever additional amount they could actually collect from the local population, an arrangement that created an obvious and well-documented incentive for these private tax collectors to extract as much as possible, often well beyond what was fairly owed, since any excess became personal profit. Before this system of tax farming could even be applied fairly, however, Rome needed a genuinely accurate accounting of who lived where and what they owned across an empire spanning 3 continents. And it was this practical need that produced one of history's most consequential administrative innovations, the periodic census. Roman officials conducted regular empire-wide surveys, recording population, property, and wealth, specifically to determine tax obligations accurately across an enormous and diverse territory, a logistical undertaking of genuinely staggering scale for the ancient world, requiring officials to travel to every corner of the empire, record detailed information about households they had often never previously had any contact with, and return that information to a central authority for tabulation. This same census system, developed specifically to make taxation more systematic and accurate, would go on to become one of the most enduring administrative tools of governance in human history, still used by virtually every modern nation today for purposes considerably broader than taxation alone, from allocating political representation to planning public services, a direct institutional descendant of an accounting exercise first developed to ensure Rome's tax farmers had an accurate baseline against which to operate. This system, whatever its administrative convenience for a sprawling empire with limited direct bureaucratic reach into every province, generated enormous and lasting resentment among the populations subjected to it, and the publicans became a notoriously despised profession across much of the ancient Mediterranean world, remembered in surviving historical and religious texts from the period as symbols of exploitation and corruption. Rome eventually moved away from this system in favor of more directly administered taxation. But the underlying lesson from this particular chapter of history has proven remarkably durable. A tax collection system that creates a direct financial incentive for the collector to extract more than is genuinely owed tends, predictably and repeatedly, toward abuse, a lesson that shaped the design of tax administration systems for centuries afterward. England, considerably later, produced one of history's more curious illustrations of how a tax can shape behavior in ways its original designers never anticipated. In 1696, facing the practical difficulty of assessing personal income or wealth directly in an era before comprehensive financial records existed, the English government introduced a window tax, levying a charge based simply on the number of windows a house had, on the reasonable assumption that wealthier households tended to live in larger homes with more windows, making window count a rough but administratively convenient proxy for overall prosperity. The predictable result, unfolding over the following century, was that many homeowners simply bricked up windows to reduce their tax bill, and new houses were sometimes deliberately built with fewer windows than their owners might otherwise have preferred. A pattern still visible today in the facades of some historic English buildings where bricked-up window outlines remain as a physical architectural record of a tax policy abandoned generations ago. This episode offers a genuinely vivid, tangible illustration of the same deadweight loss concept we discussed earlier. The tax did not simply transfer money from homeowners to the government. It also measurably changed how houses were actually built and lived in, a real cost to comfort, light, and ventilation that no tax revenue figure alone would ever capture. Medieval Europe developed its own distinct approach, less a formal tax system in the modern sense, and more a web of feudal obligations, where peasants owed a portion of their agricultural output, along with mandatory labor, to the local lord who held the land, who in turn owed military service and tribute to a higher noble or monarch, forming a layered chain of obligation that functioned as a kind of taxation without ever being formally described in those terms. This layered system meant that a single peasant's obligations were rarely owed to a single central authority, in the way a modern taxpayer owes tax primarily to a national government. A peasant might owe a portion of grain to the local lord, a separate obligation of labor for a fixed number of days, each year working the lord's own land, a toll for using a local mill or bridge the lord controlled, and occasionally an additional levy imposed by the church, each collected by a different authority for a different purpose, with little coordination or standardization between them. This fragmented structure, however cumbersome and inefficient by modern standards, reflected the genuinely decentralized political reality of the period, where no single monarch typically possessed the administrative reach or bureaucratic capacity to collect taxation directly and uniformly across an entire kingdom, relying instead on this layered chain of local lords, each collecting what was owed within their own domain before passing a portion upward to their own superior in the feudal hierarchy. A broadly comparable system developed independently, considerably further east, within the Ottoman Empire, which administered much of its territory through what was called the Timar system, granting local officials and cavalry officers the right to collect and retain a portion of tax revenue from a specific parcel of land in exchange for providing military service and maintaining local order on the empire's behalf, rather than receiving a direct cash salary from the central treasury. This arrangement, structurally quite similar to the feudal obligations developing in medieval Europe at roughly the same period, reflected a shared practical solution to a shared underlying problem. How does a government administer taxation and maintain order across a vast, difficult to communicate across territory, before modern administrative tools like reliable roads, postal systems, or standardized currency made direct, centralized tax collection genuinely practical? Both systems, developed independently on opposite ends of a connected but slow-moving medieval world, arrived at remarkably similar answers to this same underlying constraint, delegating tax collection and local governance to intermediaries in exchange for service and loyalty, rather than attempting direct central administration that the available technology of the era simply could not support efficiently. This system began to shift meaningfully in England in 1215, when a group of rebellious barons forced King John to sign the Magna Carta, a document that, among its many provisions, established a principle that would echo forward for centuries afterward, that the monarch could not impose certain taxes without first securing the consent of the nobility, an early, limited version of the idea that taxation requires some form of consent from those being taxed, rather than being purely a matter of unchecked royal decree. This principle, still narrow and limited to a small aristocratic class in 1215, gradually expanded over the following centuries as English and later British parliamentary institutions developed, gradually incorporating a broader, though still far from universal notion, that taxation required the consent of some elected or representative body rather than the monarch alone. This evolving tradition traveled directly across the Atlantic with English colonists settling in North America, who arrived carrying with them exactly this same expectation: that taxation, to be legitimate, required the consent of some representative body accountable to those being taxed. It is worth pausing on just how gradual and contested this expansion actually was, since it is easy, looking backward, to imagine a smooth, inevitable march from royal decree toward representative consent. In practice, English monarchs repeatedly attempted to raise revenue through means that sidestepped parliamentary consent entirely, through forced loans, the sale of monopolies, and various other creative fiscal maneuvers, and Parliament, in turn, repeatedly pushed back, gradually asserting and reasserting its role as the body whose consent taxation genuinely required. This back and forth, stretching across nearly 5 centuries between the Magna Carta and the American Revolution, illustrates something worth remembering about every principle we have discussed tonight. None of them arrived fully formed in a single dramatic moment. Each was fought for, tested, rolled back, and fought for again, across generations, by people who mostly never lived to see the principle fully secured in the form we now take for granted. This is where things began to shift again, quietly at first. Over the following centuries, this principle of requiring consent for taxation gradually expanded and strengthened across various European nations, eventually becoming one of the central, animating grievances behind one of history's most consequential tax disputes, the American Revolution. American colonists, subject to a series of taxes imposed by the British Parliament, including duties on tea, paper, and other goods, objected not necessarily to the existence of taxation itself, but specifically to being taxed by a legislative body in which they had no elected representation whatsoever, giving rise to the enduring rallying cry of no taxation without representation. The specific taxes that provoked the sharpest colonial reaction are worth knowing individually, since each one illustrates a slightly different dimension of the underlying grievance. The Stamp Act of 1765 required colonists to pay for a physical stamp on printed materials, including newspapers, legal documents, and even playing cards. A tax that touched an unusually broad and vocal segment of colonial society, including printers and lawyers whose own trades were directly affected, helping generate an unusually widespread and well-organized opposition. The tax generated such immediate and coordinated resistance, including organized boycotts and a coordinated Congress of Colonial Representatives convened specifically to oppose it, that Parliament repealed the act within roughly a year of its introduction, though it simultaneously passed a separate declaration explicitly asserting its right to tax the colonies in the future regardless, ensuring the underlying dispute over the principle itself remained entirely unresolved even as the specific tax was withdrawn. The Townshend Acts, following shortly afterward, taxed a range of imported goods, including tea, paper, and glass, provoking organized boycotts of British goods across the colonies. Coordinated through committees of correspondence that helped knit together colonial opposition across what had previously been quite separate, loosely connected colonial populations with limited coordination between them. And the Tea Act of 1773, despite actually lowering the overall price of tea for colonists by granting a monopoly and tax advantage to the East India Company, was perceived not as a relief, but as a further entrenchment of Parliament's asserted right to tax the colonies, without their consent, precisely the underlying principle, colonists were determined to resist, regardless of the specific financial terms attached to any single tax. This last episode is particularly worth sitting with, because it demonstrates something genuinely important about tax disputes generally. The actual financial burden of a tax is often considerably less significant to the people resisting it than the underlying question of who has the legitimate authority to impose it in the first place, and under what conditions of consent. The Boston Tea Party in 1773, in which colonists dumped an entire shipment of taxed tea into Boston Harbour rather than pay the duty owed on it, remains one of history's most vivid illustrations of a tax dispute escalating into full political rebellion. And the revolution that followed helped cement in the founding structure of the resulting nation the principle that taxation should flow from elected, representative consent rather than from unaccountable, distant authority. A remarkably similar pattern unfolded only a few years later. On the other side of the Atlantic, pre-revolutionary France maintained a deeply unpopular tax on salt called the gabelle, an essential commodity every household needed for food preservation, with the tax burden falling unevenly across different regions and social classes, and the nobility and clergy largely exempt from many of the taxes that weighed most heavily on ordinary peasants and the emerging middle class. The gabelle was structured with particular cruelty in its administrative detail. Households in many regions were required to purchase a minimum quantity of salt each year at the heavily taxed price, regardless of how much salt they actually needed. And smuggling salt to avoid the tax, a widespread and predictable response to such an onerous requirement, was punished severely, including sentences of forced labor on galley ships for repeat offenders. This deeply uneven distribution of the tax burden, falling disproportionately on those least able to afford it, while wealthier, more privileged classes remained largely exempt, became one of the central, recurring grievances fueling the growing unrest that eventually erupted into the French Revolution in 1789. Where the American Revolution centered its grievance specifically on the absence of representation in the body imposing the tax, the French Revolution centered a closely related but distinct grievance on the profound unfairness of who was required to pay it at all. Two closely related tax disputes, occurring within a generation of one another, on opposite sides of the same ocean, each reshaping the political structure of an entire nation. Both episodes reinforce the same underlying lesson. Taxation disputes rarely stay confined to narrow questions of accounting and revenue. They tend, again and again, across the history we have traced tonight, to become entangled with the largest and most consequential questions a society ever asks about fairness, representation, and legitimate authority. This same pattern reappeared, remarkably, in considerably more recent history, demonstrating that the underlying dynamic we have traced across ancient Egypt, Rome, and the 18th century has never fully disappeared from modern political life. In 1990, the British government introduced a new local tax, formally called the community charge, but almost universally known as the poll tax, replacing an existing property-based local tax with a flat charge levied on every adult resident within a local area, regardless of their income or the value of the property they lived in. The tax proved immediately and intensely unpopular, precisely because its flat structure meant a wealthy homeowner and a low-income tenant living in the same area paid an identical amount, a stark, highly visible departure from the progressive taxation principles that had shaped most other parts of the tax system for decades. Widespread non-payment, organized protest, and a notably large demonstration in London that turned into serious civil disorder followed within months of the tax's introduction. And the political fallout proved severe enough that it contributed directly to the resignation of the sitting prime minister within roughly a year. with her successor's government replacing the tax entirely within a further 2 years. This modern episode, unfolding within living memory rather than in the distant past, demonstrates that the fundamental tensions we have traced across this entire history, over fairness, over the proportionality of what different people are asked to contribute, over whether a tax's structure itself feels legitimate regardless of the specific revenue it raises, remain just as capable of generating serious political upheaval today as they were in ancient Egypt, in Rome, or in 18th century France and America. The specific technology of taxation has changed almost beyond recognition across the 5,000 years we have discussed tonight. The underlying human questions it provokes have changed remarkably little. There is a final chapter of this historical development worth knowing, since it explains the origin of the value-added tax that funds a large share of government revenue across much of the world today. The value-added tax was formally invented in 1954 by a French tax official named Maurice Loret, who was seeking a way to fund reconstruction and modernization following the devastation of the Second World War, while avoiding some of the specific distortions and evasion opportunities that had plagued earlier, simpler sales tax systems. France had previously relied on a cascading turnover tax applied at every stage of production without any credit for tax already paid earlier in the chain, meaning the same underlying value was effectively taxed multiple times as a product moved from raw material to finished good, artificially inflating prices and creating a perverse incentive for businesses to merge together simply to reduce the number of taxable transactions between separate stages of their own supply chain. Loret's innovation, collecting tax incrementally at each stage of production with credits for tax already paid earlier in the chain, solved this cascading problem directly, removing the artificial incentive toward consolidation and creating a more neutral, evenly applied tax regardless of how many separate businesses happen to be involved at each stage of a product's journey to the final consumer. The speed with which this innovation spread internationally is itself worth noting, since relatively few tax innovations in history have achieved anything close to this level of rapid, near-universal adoption. Within roughly 2 decades of its introduction in France, the value-added tax had been adopted across most of Western Europe, and within a few decades more, across the overwhelming majority of countries worldwide, from small island nations to the largest economies on Earth, making it, by some measures, the most successful and widely copied tax innovation in modern history, a remarkable outcome for a system first devised by a single official trying to solve a specific technical accounting problem in post-war France. This innovation proved remarkably successful at generating reliable revenue, while limiting the kind of large-scale evasion that a single point-of-sale tax makes easier. And France's adoption of the system was followed within a few decades by the vast majority of countries around the world, making the value-added tax one of history's more successful and rapidly adopted fiscal innovations, now used by the overwhelming majority of nations globally, with a small number of notable exceptions, relying instead on other forms of consumption tax. Let us bring together everything we have gathered so far, the mechanism from earlier, and the history we have just walked through, because this is the point where they finally lock together into something you can actually use to make sense of the news. Income tax, in the specific modern form most of us now encounter, is a considerably more recent invention than you might expect, given how central it has become to modern government finance. It was first introduced in Britain in 1799 by Prime Minister William Pitt the Younger, explicitly framed as a temporary emergency measure to fund the enormously expensive wars against a Napoleonic France, with an implicit and explicit promise that the tax would be repealed once the emergency had passed. It was, in fact, repealed after the wars ended, reintroduced briefly, repealed again, and reintroduced yet again over the following decades, in a pattern that illustrates something worth sitting with. A tax introduced as an emergency temporary measure has throughout history shown a remarkably strong tendency to become permanent, or at least to be reintroduced repeatedly. Once governments and the programs they fund come to rely on the revenue it generates. The United States followed a broadly similar path considerably later, introducing an income tax temporarily to help fund the Civil War in the 1860s, only to see it expire afterward, before finally establishing a permanent, constitutionally secured income tax with the ratification of the 16th Amendment in 1913, a change that arrived only after considerable legal and political debate about whether the federal government even had the constitutional authority to tax income directly in the first place. Following an earlier Supreme Court ruling that had struck down a previous attempt at a federal income tax as unconstitutional under the existing framework, a legal obstacle the new constitutional amendment was specifically designed to remove. There is a further chapter to the American income tax story worth knowing, because it involves a genuinely surprising historical figure and illustrates how administratively difficult collecting income tax actually is at scale. For the first several decades after its permanent establishment, the American income tax was paid in a single, large, annual lump sum, a system that worked reasonably well, as long as relatively few people owed the tax and the amounts involved were modest. This changed dramatically during the Second World War, as tax rates rose sharply and a far larger share of the working population became subject to income tax for the first time, creating an urgent practical problem: an enormous number of households suddenly owing a large annual sum they were unlikely to have reliably saved in advance. The solution, a system of automatic withholding directly from each paycheck throughout the year rather than a single annual payment, was developed with the direct involvement of the economist Milton Friedman, then working for the United States Treasury during the war. The practical case for withholding was straightforward and urgent. Without it, the government risked a wave of households simply unable to pay a large lump sum they had not adequately saved for, threatening both government revenue and household financial stability simultaneously. At precisely the moment the nation could least afford either kind of disruption. Withholding solved this by spreading the burden into smaller, more manageable increments, deducted automatically before a worker ever saw the money at all. Friedman himself later became one of the most prominent academic advocates for smaller government and lower taxation in the decades that followed, and he reportedly expressed some later ambivalence about his own wartime contribution, having helped design and implement the very withholding system that made large-scale income taxation dramatically easier to collect and considerably less visible to the ordinary taxpayer, since the tax is quietly deducted before the money ever reaches the worker's hands, rather than requiring a single highly visible annual payment that might have generated more direct, sustained public scrutiny and resistance. This detail is worth carrying forward. The specific mechanics of how a tax is collected, quietly withheld in small increments versus paid visibly in one large sum, can shape public perception and political resistance to that tax nearly as much as the actual rate charged. There is genuine ongoing debate among economists and policymakers about several aspects of this picture, worth being honest about, rather than pretending the field is more settled than it truly is. One long-running, genuinely contested area of debate concerns what is sometimes called tax incidence, the question of who actually bears the true economic burden of a given tax, which is not always the same as who is legally required to write the check. This distinction between who legally pays and who actually bears the cost is worth sitting with for a moment, because it overturns a common, intuitive assumption most people carry without ever examining it closely, that whoever a tax is formally addressed to is, straightforwardly, the party actually affected by it. Tonight's history has already hinted at versions of this same gap, most vividly in the Roman tax farming system, where the formal obligation to pay the state a fixed sum fell on the publican, but the true economic burden, inflated well beyond what was fairly owed, fell on the ordinary provincial households the publican actually collected from. Modern tax incidence analysis simply formalizes this same ancient observation into a rigorous economic framework applicable to any tax in any market at any point in this entire 5,000-year history. A tax formally levied on a business, for instance, might in practice be passed along to consumers through higher prices, absorbed by workers through lower wages, absorbed by shareholders through reduced profits, or some combination of all three, depending heavily on the specific competitive conditions of the market involved. Consider a concrete illustration. Imagine a tax levied specifically on the sale of a particular good, collected legally from the seller. If buyers of that good have very few alternatives and continue purchasing roughly the same quantity regardless of price, economists would say demand for the good is relatively inelastic. And in this situation, the seller can generally raise the price by close to the full amount of the tax without losing many customers, meaning the true economic burden falls mostly on the buyer, even though the seller is the one legally responsible for remitting the tax to the government. Essential medications offer a fairly clear real-world illustration of this inelastic end of the spectrum. A patient who genuinely needs a specific medication has very limited ability to simply stop buying it or switch to an unrelated alternative in response to a price increase, meaning a tax applied at this stage tends to be passed through to the patient nearly in full. Governments are in fact well aware of this dynamic, and it shapes tax policy in specific, deliberate ways worth naming. Many countries apply reduced tax rates or outright exemptions, specifically to categories of goods where demand is known to be highly inelastic and where the population purchasing them is considered least able to absorb the full tax burden. Basic groceries and prescription medications being frequently cited examples, precisely to soften the regressive effect this kind of inelastic demand would otherwise produce. Conversely, some governments deliberately target taxes toward goods with genuinely elastic demand specifically because they want to discourage consumption of that good, rather than simply raise revenue efficiently. Tobacco and certain sugary beverages being commonly cited examples, accepting that a meaningfully elastic response, people actually reducing their consumption in response to the tax, is treated as a feature of the policy rather than a flaw, since discouraging consumption of the taxed good was the explicit goal from the outset, distinct from the pure revenue-maximizing logic that shapes most other tax design. If, instead, buyers have many easy alternatives and would readily switch to a different product at the slightest price increase, demand is relatively elastic, and the seller, unable to raise prices without losing substantial business, ends up absorbing most of the tax's true burden through reduced profit margins, even though nothing about the legal structure of the tax itself has changed. A tax applied to one specific brand of a widely available, easily substitutable product where dozens of nearly identical alternatives sit on the very same shelf illustrates this more elastic end of the spectrum. Since a seller raising prices even slightly risks losing customers to a nearly identical competitor sitting immediately alongside it, this is precisely why economists insist on distinguishing carefully between the legal incidence of a tax, who is formally required to pay it, and its economic incidence. Who actually ends up bearing its true cost once all these market adjustments have played out? A distinction that frequently surprises people encountering it for the first time, since the two can diverge quite dramatically depending on the specific market conditions involved. Economists use tools examining the relative flexibility of supply and demand in a given market to estimate how a particular tax's true burden is likely to be distributed among these different groups. And this analysis frequently reveals that the legal target of a tax and its actual economic burden diverge meaningfully. A genuinely important and often counterintuitive finding that complicates simple assumptions about who really pays for any given tax. There is a second area of genuine, active debate worth understanding, one that touches directly on contested questions of tax policy still argued about vigorously today: the relationship between tax rates and total government revenue, sometimes illustrated using what is called the Laffer curve, named after the economist Arthur Laffer, who popularized the idea in the 1970s, reportedly first sketching the concept on a restaurant napkin during a dinner conversation with government officials. An origin story that has become one of the more famous, if perhaps partly embellished, anecdotes in modern economic policy history. The underlying idea itself, setting aside the napkin story, was not entirely new even at the time Laffer popularized it, and economic historians have traced similar observations about the relationship between tax rates and revenue back considerably further, including to writings from medieval Islamic scholarship and to observations made by various 18th and 19th century economists studying the effects of specific tax changes on smuggling and evasion. What Laffer contributed was a particularly clear, visually memorable framing of an idea that had existed in scattered form for centuries, packaged in a way simple enough to sketch on a napkin and vivid enough to reshape an entire era of tax policy debate, a genuinely striking illustration of how the specific presentation of an economic idea, not merely its underlying substance, can shape how much influence it ultimately has on real-world policy. The underlying logic is straightforward at its extremes and more genuinely contested in the middle. At a tax rate of 0%, a government obviously collects no revenue at all. At a tax rate of 100%, most economists agree a government would also collect little to no revenue, since almost no one would have any remaining incentive to engage in taxed economic activity at all if the entire proceeds were confiscated. Somewhere between these two extremes, logically, there must exist a rate that maximizes total revenue, and the curve connecting these points rises from zero, reaches some peak, and falls back towards zero again at the highest possible rate. Where any specific real-world economy actually sits along this curve, and therefore whether raising or lowering a particular tax rate would increase or decrease total government revenue, is a genuinely and vigorously contested empirical question, not something the basic logical shape of the curve alone can answer. Advocates for lower tax rates have historically argued that many developed economies sit on the descending portion of this curve for at least some taxes, meaning rate cuts could, in their view, actually increase total revenue by sufficiently stimulating additional economic activity to offset the lower rate applied to it. Advocates for higher rates or maintaining existing rates have historically argued that most developed economies actually sit considerably below the revenue-maximizing peak, meaning rate cuts would primarily just reduce revenue without generating enough additional economic activity to compensate. Economists across the political spectrum generally agree the Laffer curve's basic logical shape is sound, while disagreeing considerably based on differing empirical estimates and differing underlying economic models about where any specific real-world tax rate actually falls along that curve, making this one of the more genuinely unresolved, actively researched, and politically significant debates in contemporary tax policy. There is a third area of active debate worth knowing, one that has grown considerably more prominent as trade and investment have become more globally interconnected. Tax competition between different countries, sometimes described, depending on one's perspective, either as healthy competitive pressure, keeping government spending disciplined and efficient, or as a race to the bottom that erodes the tax base needed to fund public goods. Some jurisdictions around the world have deliberately structured their tax systems, particularly corporate tax rates, to attract international business investment and headquarters, sometimes referred to informally as tax havens. And businesses and wealthy individuals routinely make legal decisions about where to locate income, assets, and operations, partly in response to these differing tax structures across borders. This dynamic connects directly to the tax avoidance concept we will discuss shortly. A multinational business legally structuring its operations to record profit in a lower tax jurisdiction, wherever it is genuinely permitted to do so under the applicable laws of the countries involved, is engaging in exactly the kind of legal tax avoidance that has always existed in some form. Simply operating at a considerably larger, more internationally coordinated scale than an individual household, adjusting its own affairs, economists and policymakers hold genuinely differing views on how significant a problem this presents. Differing on how much this competitive pressure meaningfully constrains any single country's ability to set its own tax policy, and differing on whether international coordination to limit this kind of competition would, on balance, improve or worsen overall economic outcomes, a debate that has intensified in recent years as several international bodies have pursued coordinated efforts to establish minimum global corporate tax standards specifically to address these concerns, with countries and economists continuing to disagree about the appropriate balance between national sovereignty over tax policy and international coordination to prevent this kind of competitive erosion. There is a fourth area of active debate worth understanding, one that has become considerably more prominent in public discussion in recent years: the question of whether accumulated wealth itself, as distinct from income or consumption, should be taxed directly, and if so, how. Most tax systems around the world tax income as it is earned and consumption as it occurs, but generally do not impose an ongoing annual tax on the total accumulated value of a person's assets simply for existing, beyond the property tax we discussed earlier, which applies specifically to real estate rather than wealth in general. Advocates of a broader wealth tax argue that concentrated accumulated wealth, particularly wealth held in forms like stocks or business ownership that can grow substantially without ever being converted into taxable income, represents a meaningful gap in most existing tax systems, one that allows wealth to compound largely untaxed for extended periods. Critics of a broader wealth tax raise several practical concerns, including the genuine difficulty of accurately valuing certain kinds of assets, particularly ownership stakes in private businesses, without any public market price on an annual basis, and concerns that a wealth tax could encourage the relocation of assets or of wealthy individuals themselves to jurisdictions without such a tax, echoing the tax competition dynamic we just discussed. Several countries have experimented with wealth taxes over recent decades, and the results have been genuinely mixed, with a number of countries that once had broad wealth taxes subsequently narrowing or repealing them, citing exactly these administrative and competitive challenges, while other countries continue to maintain more limited versions, applying only to the very largest fortunes. This remains a genuinely active area of both economic research and political debate, without a settled consensus among economists about the ideal design or even the basic desirability of this kind of tax. It is worth noting, in closing this particular thread, that every debate we have surveyed tonight, the Laffer curve, tax incidence, tax competition between nations, the question of a wealth tax shares a common underlying shape, a genuine unresolved tension between the desire to fund collective goods reliably and fairly and the equally genuine desire to avoid discouraging the very economic activity, work, investment, saving that generates the resources being taxed in the first place. Different societies in different eras have struck this balance differently, exactly as we saw with the Roman census, the Hanseatic-style delegated collection of medieval Europe, and the value-added innovation of post-war France. There is no single correct point on this balance waiting to be discovered by sufficiently careful economic analysis. There is only the ongoing, continuously renegotiated compromise each generation reaches for itself, using whatever tools, whatever institutions, and whatever political imagination happen to be available to it. So what does all of this mean for us? Not for historians and economists studying tax incidents and centuries-old rebellions, but for the quiet daily life that most of us are actually living, lying here in the dark, thinking about our own paycheck or our own tax return, rather than a parliamentary debate from centuries ago? It is worth pausing, before moving into what this means for you specifically, to notice just how much of tonight's history has been a story of ordinary people in ordinary moments, discovering that a tax touched their lives more directly than they expected, and responding in ways large and small, peaceful and otherwise. A scribe measuring a flood, a homeowner reaching for bricks and mortar, a crowd gathering at a harbor, a household quietly deciding to hoard a little extra salt, a British household 3.5 centuries later refusing to pay a flat local charge it considered fundamentally unfair. None of these people set out to make history. They were simply responding, as best they could, to the specific shape taxation happened to take in their own particular moment, exactly as you are doing tonight, filling out your own forms, checking your own paycheck, in a moment that will, in its own quiet way, become part of this same, very long, ongoing story. So what do we do with all of this? Let us start by dismantling a few myths, gently, now that we have the full picture in front of us. The first myth is that taxation itself is a modern imposition, a burden invented by contemporary governments with no basis in how earlier, freer societies supposedly functioned. As we have seen tonight, mandatory contribution to fund collective goods stretches back at least 5,000 years to some of the very earliest organized civilizations in recorded history, taking the form of grain, labor, or currency depending on what a given society actually had to offer. Taxation, in some form, is not a modern invention. It is one of the oldest, most consistently recurring features of organized human society, appearing in, essentially, every civilization complex enough to require roads, defense, or any other collectively funded undertaking. The second myth, and one that touches on a genuine ongoing political and philosophical disagreement that this channel will not attempt to resolve or take sides on, concerns the fundamental nature of taxation itself. One perspective, with a long and serious intellectual history, holds that taxation represents an unavoidable but essentially coercive taking of privately earned income, to be minimized wherever practically possible in favor of voluntary exchange and private provision. A different perspective, with an equally long and serious intellectual history, holds that taxation represents the necessary, collectively agreed price of living in an organized society, funding the courts, infrastructure, and shared institutions, without which private economic activity itself could not reliably function or be protected in the first place. Both perspectives can point to real historical evidence in their favor, drawn from exactly the history we have traced tonight. Those emphasizing the coercive nature of taxation can point to the Roman publicans, extracting far more than was fairly owed under a system that gave them every incentive to abuse their position, or to the gay bell, falling crushingly on those least able to bear it while the privileged remained exempt. Those emphasizing taxation as the necessary price of a functioning society can point to the roads, courts, and public infrastructure that voluntary contribution alone has throughout history proven remarkably unreliable at funding. Exactly the free rider problem the lighthouse illustration made concrete earlier tonight. There is a third perspective worth naming as well, one that does not so much resolve the disagreement between the first two as reframe it slightly. The observation, drawn directly from tonight's history, that the specific balance between coercion and consent in any given tax system has never been fixed or permanent, but has instead shifted continuously, generation after generation, through exactly the kind of negotiation, sometimes peaceful and sometimes violent, that we traced across Magna Carta, the American Revolution, the French Revolution, and the British poll tax protests. Rather than a single correct answer waiting to be discovered, what the historical record actually shows is an ongoing, never-finished process of renegotiation with different societies in different eras, striking that balance differently and revising it again whenever the existing arrangement comes to feel sufficiently unfair or illegitimate to enough of the people living under it. Both perspectives draw on genuinely serious economic and philosophical reasoning, and reasonable, well-informed people continue to disagree, often quite passionately. About where the proper balance lies between these two framings, a disagreement this channel will simply lay out honestly rather than resolve, since it reflects a genuine difference in values and priorities, rather than a straightforward factual question with a single correct answer. The third myth worth naming directly concerns a distinction many people blur together without quite realizing it: the difference between tax avoidance and tax evasion. Tax avoidance refers to the entirely legal practice of structuring one's financial affairs to minimize tax owed, using deductions, credits, and structures explicitly permitted and often deliberately created by the tax code itself. Tax evasion refers to the illegal practice of concealing income or falsifying information specifically to avoid paying tax that is genuinely legally owed. Consider a simple everyday illustration of each. A household contributing to a retirement savings account specifically because that contribution reduces their taxable income, exactly as the tax code intends and encourages them to do, is engaging in straightforward tax avoidance, using the system exactly as designed. A household that simply fails to report a portion of its actual income, hoping it goes unnoticed, is engaging in tax evasion, a criminal act, regardless of how modest the concealed amount might be. It is worth adding a further layer of nuance here, since the line between these two categories, while conceptually clear, can occasionally become genuinely contested in specific, complicated cases involving sophisticated financial structures, particularly among larger businesses and wealthier individuals, with access to considerably more elaborate planning than an ordinary household's retirement contribution. Tax authorities in many countries maintain a further concept, sometimes described as aggressive tax avoidance, or, in some legal traditions, an anti-abuse doctrine, specifically to address arrangements that comply with the literal, technical wording of tax law while arguably violating its underlying intent or spirit. Structures deliberately engineered to exploit an unintended gap or loophole, rather than to take advantage of a deduction or credit the law was actually designed to encourage. distinguishing this kind of aggressive, boundary-pushing avoidance from more straightforward, clearly intended avoidance, like the retirement contribution example, and from outright illegal evasion, remains a genuinely difficult, sometimes contested area of tax law and enforcement. One where courts and tax authorities continue to draw and redraw lines as new, increasingly creative financial structures are developed. These are not simply 2 points on the same spectrum of moral acceptability, gradually shading from mildly aggressive to seriously wrong. They are categorically different in the eyes of the law. One is a legal, often quite deliberately designed feature of how a tax system operates, and the other is a criminal act. Confusion between these two concepts fuels a great deal of unnecessary anxiety among ordinary taxpayers, simply claiming deductions and credits they are genuinely entitled to under the law, worried they are somehow doing something ethically questionable, when in reality they are using the tax system exactly as its own designers intended it to be used. Governments themselves regularly create and expand these legal deductions and credits quite deliberately, specifically to encourage certain behaviors they consider beneficial: retirement saving, home ownership, charitable giving, education, or business investment among common examples, meaning that claiming them is not merely permitted, but is, in a genuine sense, the tax system working precisely as its designers intended, not a clever exploitation of some unintended loophole. The fourth myth, and perhaps the one most worth sitting with, is the fear that the sheer complexity of a modern tax system, with its brackets, credits, deductions, and layered categories, reflects either deliberate obfuscation or outright incompetence on the part of the people who designed it. What we have walked through tonight suggests a different, more honest explanation. Modern tax systems are complex, largely because they were built up gradually, layer by layer over centuries. Each new tax or provision added at a different historical moment to solve a specific, immediate problem, from funding a war against Napoleon to closing an evasion loophole discovered decades later. This is a genuinely different kind of complexity than the complexity of, say, a deliberately obscure legal contract designed to confuse. It is closer to the complexity of an old house, repeatedly renovated and expanded by different owners across different generations, each addition sensible in its own moment. The accumulated whole considerably more tangled than any single architect would ever have designed from scratch, but explicable piece by piece once you understand the history behind each individual addition. This same old house analogy is worth extending a little further because it captures something else worth understanding about why reforming a tax system, however genuinely desirable in the abstract, tends to prove so much harder in practice than simply designing a cleaner system from scratch would suggest. Renovating an old house that has been added onto repeatedly across generations is always more complicated than building an equivalent new house on an empty lot, since every existing addition constrains what can be changed without disrupting something else that depends on it. Tax systems face exactly this same constraint. A deduction introduced decades ago to encourage a specific behavior may have since become deeply embedded in how millions of households or businesses plan their finances, meaning removing it, however clean and sensible the removal might look on paper, would create real, disruptive costs for everyone who had organized their affairs around its continued existence. This is a genuine part of why comprehensive tax reform, discussed periodically in nearly every country we have touched on tonight, proves so difficult to actually achieve, even when broad agreement exists that the current system has become needlessly complicated. Let us address a specific fear directly and gently, because it surfaces so often around this particular topic: the quiet anxiety of sitting down each year to complete a tax return. Uncertain whether every deduction has been properly claimed, every form correctly filled, every number accurately reported, part of what makes this task feel so uniquely stressful is precisely the layered, historically accumulated complexity we just described. A system that genuinely was never designed comprehensively from scratch by a single mind, but assembled gradually across centuries by many different hands, solving many different problems. This does not make the annual task any less tedious, but it does reframe the source of the difficulty. The complexity you are wrestling with each year is not a personal failing in your own understanding, nor a system deliberately built to confuse you specifically. It is the accumulated residue of a genuinely ancient, ongoing negotiation between societies and the individuals within them. Stretching back to Egyptian scribes measuring the Nile's flood and English barons forcing a king's signature, still being renegotiated in smaller and larger ways every single year. There is a related worry worth naming as well, one that tends to surface specifically around the moment a tax authority requests additional documentation or clarification, a moment that can feel disproportionately alarming even when the underlying issue is entirely routine. Given how many layers of historical accumulation we have traced tonight, each with its own specific rules, exceptions, and documentation requirements, a request for clarification is, in the overwhelming majority of cases, simply part of the ordinary administrative process of matching a complex, historically layered system against an individual return rather than a signal of serious wrongdoing. The vast majority of these routine requests are resolved through simple, straightforward clarification. Precisely because the system's complexity, the same complexity we have spent tonight tracing back through centuries of accumulated history, makes this kind of routine back and forth an ordinary, expected part of how the system functions for a great many ordinary taxpayers, rather than an unusual or alarming exception. It is worth adding, finally, a small piece of reassurance grounded directly in everything we have walked through tonight. The sheer difficulty and complexity of modern tax filing is itself a well-documented, widely shared experience, not a sign that you, specifically, are somehow uniquely bad at understanding a system that everyone else navigates effortlessly. Surveys of taxpayers across many countries consistently find that a large share of ordinary people report genuine confusion, genuine stress, and genuine uncertainty about whether they have completed their own filing correctly, an experience so widely shared that entire industries, tax preparation services, and specialized software exist specifically to help ordinary people navigate a system that even trained professionals sometimes find genuinely complicated in its more unusual corners. There is a related, more forward-looking area of active debate worth knowing, because it illustrates that this same ancient negotiation continues actively today. The question of how tax systems, largely designed around physical goods, physical presence, and traditional employment, should adapt to an increasingly digital, globally mobile economy, where a company can generate substantial revenue in a country without maintaining any significant physical presence there at all, and where income can be earned and assets held across multiple jurisdictions with unprecedented ease. This challenge stems from a structural assumption built into most tax systems since their earliest modern development, that taxable economic activity generally occurs somewhere specific, tied to a physical location, a factory, a storefront, an office that a tax authority can identify and assess. A company selling digital services to customers in dozens of countries simultaneously, with no physical office or warehouse in most of them, does not fit neatly into this older assumption, raising genuinely difficult questions about which country, if any, has the strongest legitimate claim to tax the resulting revenue? The country where the company is legally headquartered? The country where its customers are located? Or some combination or apportionment between the two? Several countries, frustrated by the slow pace of international coordination on this question, have introduced their own unilateral digital services taxes, applying a specific tax rate directly to revenue certain large technology companies earn from users within their borders, regardless of where those companies are formally headquartered for other tax purposes. These unilateral measures have themselves generated considerable friction, since countries whose companies are most directly affected have sometimes viewed them as unfairly targeted, and negotiations over a broader, internationally coordinated alternative have continued for years without full resolution, illustrating just how genuinely difficult it has proven to update a tax framework built around physical presence for an economy where a meaningful share of value creation no longer requires physical presence in any conventional sense at all. Governments and international bodies have spent considerable effort in recent years attempting to update tax rules originally designed for an economy of physical factories and local storefronts to better address this newer reality, and reasonable disagreement continues about exactly how best to allocate taxing rights over this kind of increasingly borderless economic activity among the many different countries that might each have some legitimate claim to a share of it. A genuinely modern chapter in the very old story of societies, working out, case by case, exactly what is owed and to whom. There is a natural question that tends to surface right about now. Lying here, having walked through 5,000 years of grain, measured against a flooding river, resentful provinces, paying private tax farmers, bricked up windows, and 2 revolutions fought, at least partly, over the fairness of a tax. If this disagreement over what we owe each other is this old, this recurring, and this unresolved even after 5 millennia of continuous practice, what was the point of walking through all of it tonight? It is worth adding one further reflection here, drawing together several threads from across tonight's history at once. Every single tax innovation we discussed, the census, the value-added tax, automatic withholding, even the ill-fated window tax, was, in its own moment, an attempt to solve a genuine practical problem: how to measure fairly, how to collect reliably, how to avoid the specific abuses of whatever system had come before it. None of these innovations arrived as a perfect final solution, and each, in time, revealed its own new set of problems that some future innovation would eventually need to address in turn. This pattern, imperfect solutions, gradually replacing previous imperfect solutions, each one an improvement along some specific dimension, while introducing its own new complications, is not a sign of failure. It is simply what genuine, incremental human problem-solving looks like, stretched out across 5,000 years rather than compressed into the tidy narrative of a single evening. The answer, again, is quieter than it might first appear. Understanding this history does not settle the genuine, ongoing disagreement about how much taxation is fair, or how it should be structured, or who should bear its burden. Disagreements this channel has deliberately declined to resolve on your behalf, since they reflect genuine differences in values rather than a simple factual question. Nor does it change the specific number owed on your own return, or the specific amount already deducted from your own paycheck before you ever saw it. What understanding this history does offer is something more modest: the ability to recognize your own tax return, your own paycheck deduction, your own property tax bill, not as an arbitrary, uniquely modern imposition, but as the latest chapter in a genuinely ancient ongoing negotiation that every society, in every era we have discussed tonight, has had to conduct in its own way, with its own tools, arriving at its own imperfect answer. There is something worth adding here too about the specific comfort available in recognizing a pattern this old and this consistently recurring. A dispute that has appeared in some recognizable form in essentially every organized society complex enough to require roads, courts, or collective defense is not a personal failing of your own particular government, your own particular era, or your own particular life circumstances. It is, instead, a structural feature of what it means to live inside any society large enough to need things that no single individual can build alone. Precisely the free rider problem and the lighthouse we described near the very beginning of tonight, playing out again in whatever specific form it happens to take in the country and the era you personally find yourself living in. So what do we do with all of this in practical terms? The answer, and this might be the least satisfying part of everything we have explored tonight, is that there is no single answer. The economy is not a machine you can tune with a screwdriver. It is billions of people making decisions every day, and the patterns that emerge are real but not fully controllable. What we have done tonight is not give you a strategy. It is give you the words, the framework, the understanding you need to make sense of the headlines, to ask better questions, and to sit with uncertainty without it turning into fear. For the rest, the decisions about what to do with your own resources, that is between you and your own judgment, ideally informed by professionals who understand your specific situation. What we have done tonight is give you something quieter, but maybe more lasting. The ability to see the system clearly. And sometimes that is enough. There is a quiet, human thread running underneath everything we have covered tonight, worth pulling into the light before we let this rest. Every tax ever collected, from Mesopotamian grain and labor recorded on the very first clay tablets human civilization ever produced, to Egyptian grain measured against the flooding of the Nile, to Roman publicans extracting their profit from a resentful province, to English homeowners bricking up their own windows, to a shipment of tea dumped defiantly into Boston Harbour, to William Pitt's supposedly temporary wartime measure, to Milton Friedman quietly redesigning how an entire nation collects its income tax during a different war entirely, to a British Prime Minister's downfall triggered in part by a single deeply unpopular local charge, ultimately rests on the same basic ancient tension, a society needing to fund what it cannot fund individually, and the individuals within that society negotiating sometimes peacefully and sometimes through open rebellion exactly how much they owe, to whom, and under what conditions of consent. It is worth remembering, too, that almost none of the people at the center of this history were simple villains or simple heroes. The Egyptian scribes measuring the Nile's flood were, in their own way, attempting a genuinely more humane, more responsive system than a flat, unchanging levy would have been. Roman census officials, however, resented the publicans who ultimately used their data, were attempting to bring genuine administrative order to an empire spanning 3 continents. William Pitt genuinely believed his income tax would be temporary, and was, by most accounts, sincere in that belief, even as history proved otherwise. Milton Friedman helped build a system he would later have complicated feelings about, precisely because he understood, better than almost anyone, exactly how much easier it would make large-scale taxation to sustain indefinitely. Maurice Laurey was simply trying to fund the rebuilding of a devastated nation more fairly and more effectively than the systems that had come before. The story of taxation, examined honestly across the 5,000 years we have traced tonight, is less a simple morality tale of oppressors and the oppressed, and more a genuinely complicated, ongoing negotiation, conducted by people doing their sincere best with the tools, the knowledge, and the political constraints available to them in their own particular moment. There is something worth carrying forward from this entire sweep of history, regardless of where any individual listener happens to land on the genuine philosophical disagreement we described earlier tonight, between taxation as coercion and taxation as the price of civilization. Every single generation we have discussed, from Mesopotamian farmers pressing marks into wet clay, to Egyptian farmers watching a rising river, to Roman provincials, to English barons, to American colonists, to French peasants, to a British electorate rejecting a single flat charge within living memory, to modern taxpayers filling out their own forms tonight, has had to conduct this same negotiation for itself, using the tools, the institutions, and the political imagination available in its own particular moment. None of them inherited a perfect, finished answer from the generation before. Each contributed something, sometimes through peaceful reform, and sometimes through open rebellion, to the ongoing, unfinished shape of the answer we have inherited today, itself destined to be revised further by whatever generation comes next. There is something worth carrying forward from this long, patient history of trial and correction, the recognition, running through every era we discussed, that measuring and collecting fairly is itself a skill that improves only slowly, through trial, failure, and correction, never arriving at a final perfected form, but genuinely, incrementally getting better at serving the underlying purpose it was always meant to serve, funding what a society cannot fund alone. You are lying there now, in the dark, perhaps thinking faintly of a tax form, a paycheck, or a question about whether you are paying your fair share. Think for a moment of the Egyptian scribe standing beside the rising Nile, marking a measurement that would determine how much grain a household owed that season. Think of the barons at Runnymede forcing a reluctant king to put his name to a document that would echo for 8 centuries afterward. Think of a chest of tea sinking slowly into Boston Harbour, and a crowd of colonists watching, uncertain themselves of exactly what they were setting in motion. Think, too, of an economist in a wartime treasury office quietly designing a system of small automatic deductions that would make an entire nation's tax collection dramatically simpler, never quite resolving his own later unease about what he had built. None of them could have imagined a quiet room, centuries or millennia later, where someone lies awake wondering about a paycheck deduction. And yet every one of them is, in some small way, still present in that very deduction, in the shape it takes, in the assumptions embedded inside it, about consent, fairness, and what a society owes itself. Think, finally, of a Mesopotamian scribe pressing careful marks into wet clay 4,000 years ago, recording exactly how much grain a household still owed the temple, never imagining that this same basic act, tracking a mandatory contribution, resolving a dispute over whether too much had been demanded, would still be recognizable in its essential shape. In a tax authority's database somewhere in the world tonight, the tools have changed beyond anything that scribe could have imagined. The underlying gesture, a society keeping careful account of what its members owe one another, has not changed nearly as much as it might seem. The tax will still be owed, the form will still need filing, but now you know why and where this entire sprawling system actually came from. There is a strange peace in that, in seeing the pattern, even when the pattern is not something you can personally change from where you are lying right now. It never was, for anyone, in any era. And somehow, across 5,000 years, it has always, eventually, worked out well enough. The economy is not a natural disaster happening to you. It is a human creation shaped by human choices, made across centuries by people solving the problems directly in front of them with the tools they happen to have. And we are inside it, all of us, together, still negotiating, generation after generation, the same basic question that has shaped this entire history. What do we owe each other? And how do we fairly decide it? Not perfectly, not permanently, but well enough, most of the time, to keep the roads paved, the courts open, and the quiet, ordinary machinery of a shared life running for one more year. And as you lie there, the world continues to turn. Somewhere, a form is being filed. Somewhere, a government is deciding how to spend what has been collected. Somewhere, a debate about fairness older than any nation currently in existence continues quietly in the background. Somewhere, a young civil servant is drafting the next small incremental reform to a system that will never be perfectly finished and will not need to be, to keep serving the same quiet purpose it has served since the very first mark was pressed into wet clay. And here, in the dark, none of it needs your attention. It simply is, as it always has been, as it will be tomorrow.